analysts have painted a grim picture of the effects of rising interest rates on the property sector. It comes as the South African Reserve Bank hiked the repo rate this week by 25 basis points due to rising inflation. Let's get you some analysis now. FNB's property analyst, in fact, John Loos, joins us in studio for more on the story. John, welcome. Thanks very much for coming in. And it's interesting to see that two members of the committee actually wanted to increase the rate by 50 basis points.
Yeah,
it could have been worse.
It could have been worse, and I think a lot of questions, potential inflationary pressures come around the war in the Ukraine now, additional ones. We've already had the global supply side constraints from various supply chain disruptions causing an inflation problem worldwide. Now you've got a potential food price impact and oil price impact from the war in the Ukraine, depending on how far that goes. So there are a lot of inflation risks, not easily predictable, but risks, which place an upside risk on interest rates.
Let's not forget about electricity prices as well.
Well, I mean, the SARB has factored that quite a big assumption for increases in, but yes, electricity prices, municipal rates and tariffs possibly too. Those relate directly to property operating costs too. Those are a troublesome issue for property,
For homeowners, for people with loans, mortgages, it was a big blow yesterday.
Well, I wouldn't say a big blow, but it's starting to becoming noticeable. 25 basis points on its own is not a big blow, but now you've got to 25 basis points. It's starting to become more noticeable, and our expectation is that in subsequent meetings this year they'll carry on with the normalization, which a lot of people are calling it, of interest rates, 25 basis points a meeting. So it can eventually, by the end of the year, it can start to become quite significant.
Well, the reason why I was saying a huge blow is just because of the other pressure on consumers. We talk about the rising cost of food, fuel, electricity. All of that's happening in a context where I'm not getting an increase to my salary.
Yeah, I think that is the big issue, is that we've gone through 2020 was the biggest recession in 100 years. The household sector took quite a big financial knock. Then you've got the effect of tax rate going up with bracket creep, so tax as a percentage of disposable income, that's been rising for some years now, the rates and the tariffs. And if it's a food price inflation shock that comes out of the Ukraine, that's particularly damaging, especially for lower income groups, because that's a big part of the spending basket. So hopefully not too bad there, but there are some potential risks too.
We're in a hiking cycle, that's what we're told, right?
Yes.
How long is it going to last?
Well, we think that it could last into next year, and we could go up more than another 1 percentage point. I think what one must also appreciate is that the Reserve Bank did lower rates to an abnormally low level.
Right.
And repo rate is negative in real terms. It's below general inflation. So I think the SARB would want to at least have it up where it's positive in real terms. So it's more a normalizing. There are inflationary pressures, so they've had to start hiking. But there's also just one looks back at the way they cut in 2020 because of an abnormal crisis. And now it's time to normalize rates to where they should be given our structural inflation levels.
Yeah. We've been talking about the impact particularly on the property sector insofar as this hiking cycle is concerned. As banks, are you feeling that pressure that consumers are passing on in a way to the banks, their inability to service their debts, for example?
It's not bad. I mean, in recent years, if one looks at the NCR data which is public, for, say, home loans, non-performing loans or arrears as a percentage of total loans outstanding, still relatively low. It was creeping up even before the COVID lockdowns. It had been creeping up for a little bit as a percentage of total loans. That more on the back of economic stagnation over quite a number of years, which does filter through to the household sector. But relatively low interest rates have kept the arrears situation relatively good still. It's not a 2008 blowout, global financial crisis where the interest rates went up by 5 percentage points. So interest rates are key here, and the SARB needs to hike gently because it's a vulnerable household sector. It's a highly indebted household sector. It's vulnerable. And a business sector as well, on the commercial property side too, definitely vulnerable there too. So, and I think they're mindful of that, and that's why, I mean, you look at the hiking cycle. I mean, hiking rates are never popular with people who have debt, but 25 basis points, it's not the 50 or the 100 basis points that they used to hike at.
Yeah, yeah.
I think the SARB has become more sensible to growth issues and the fragile nature of the economy in more recent times.
Yeah. The impact on, particularly, when we talk about the recovery of our economy post-COVID, we always talk about the small business sector. And you've just mentioned commercial property as part of the sector that will be impacted by this increase in rates. Have you seen that reflecting already insofar as perhaps less lending or an impact of any sort?
Well, if one looks at certain financial figures not related to the bank, so let's look at tenants, the tenant populations for office, industrial and retail.
Right.
As in TPN's data, tenants in good standing with their landlords regarding their rent. I mean, the retail sector, and I think it's more the smaller retail operators in the centres. I mean, it's 64% of tenants in good standing with their rentals. That's pretty dismal.
As opposed to, yeah?
Well, okay, before COVID, they were up well into the 70s, and even that was getting weakish. They took a knock to 41% in 2020, recovered somewhat, but only got to 64. So still under pressure, especially in the retail tenant side. So we've seen pressure. A lot of it not due to interest rates hiking. I don't think interest rate hiking pressures we've seen too much of yet. It's more still a lot of, on the commercial side, tenants trying to get their way out of the hole that they were in with the lockdowns and the loss of revenues there. That was the real big knock.
Yeah, the recovery. We are seeing a lot of empty office and shop space in the malls these days.
The office space and the work from home, that's a challenge for the landlords there. Yep. There's other challenges, I think, in the commercial sector which are more significant than interest rates. The work from home, the online retail, those are the bigger issues, I think.
Yeah, the interest rate is just one more thing. John, thanks very much for coming into studio, giving us your perspective there. John Loos is an economist at First National Bank as we continue to track the impact of the interest rate hike that was announced just yesterday.